Hello, and welcome to this webinar on why accessing the foreign exchange market via a market maker is the most efficient way to trade. The purpose of this presentation is to explain why a market maker is able to provide a tighter spread than a broker or an ECN can to assist retail traders to access the market in the most efficient way possible. Our background as market makers was that we ran the Barks business for Barclays Capital since 2004, and we were declared and committed market makers using the technology to generate all of the rates and run all of the risk automatically, which had the advantage of allowing us to be highly scalable, first of all, and also to ensure that our rates were both neutral, that the machine was consistent, and that we incorporated as much information as we could in order to be able to display the best possible rates. The empirical proof that we were doing okay at that, I think, was the growth and the turnover of the business, which was 25 times over the period from about 2004 to 2010. So there's some reflection in that what we assumed was actually read well by clients. So the first thing in the presentation is the question of what a market maker is. What exactly does a market maker do? The next question that we're going to actually look at is why, in the course of acting as a market maker, they take the risk into their books, which is distinct from what a broker does, who passes the risk on to somebody else who takes the risk into their book. Why it is that the differing horizons that the retail trader has from the market maker means that this notion that market makers are set up to trade against you is not in fact true. And why all of this resolves down to market makers being able to show traders better spreads than brokers can. And then when we run through all of that, I'll just open it up for questions. So a market maker in foreign exchange can be defined as a company or an individual that continuously forms and publishes a two-way price in a currency, standing ready to buy or sell at the time of a client's choosing. They then take the risk into their book to try and effectively link buyers and sellers over time. So the first question is, what information does the market maker listen to in forming their rate? One of the tremendous developments in foreign exchange over the last 15, 20 years has been the number of electronic environments that have made price discovery far less frictionful than it used to be in the voice-driven markets. So a market maker will typically listen to multiple sources, whether that be EBS or Reuters, Hotspot, Coronex, all the various ECNs, and consolidate all of that information to try and generate the most perfect rate. What's meant by perfect we'll address in a second. There's an absolute fire hose of data which is coming down each of these streams, and so there's a tremendous amount of computing power to be able to assimilate it all and generate the best possible rate. So there's the application of that computing power to generate ultimately the two-way rate that the client can trade upon. Now, in forming the rates, the market maker is trying to optimize two distinct things. One, the neutrality of the rate, and two, the certainty of the rate. The more neutral the rate, the more attractive it is to both buyers and sellers. A market maker has no advance notice of whether a particular client wishes to buy or sell. So by publishing the most neutral possible rate, they maximize the prospect that clients are going to wish to trade on the rate with the market maker. The other thing that they're looking to optimize is to take out as much uncertainty about what the rate is as they can. The more certain you can be of the rate, ultimately, the tighter the spread can be. Now, market makers are only ever estimating where the price is. They don't know it with perfect certainty because the information is distributed across so many different environments. Prices are constantly moving. Orders are being placed and withdrawn from multiple environments very, very quickly. And so the value of the information that you have is constantly being updated. Old information is decaying in value. New information is always coming in. So it's very much an ongoing real-time process. So having listened to all of that information, the net result is a price that clients can trade upon. Once clients trade upon that rate, the thing that distinguishes a market maker from a broker is the willingness of the market maker to take the risk into their own book. So, what does it mean for a market maker to take risk into their book, and why do they do it? Well, I think the best way to try and expose this is to assume that a market maker has a number of clients and start with client one. Client one is going to sell to the market maker, thinking that the market goes down. Now, the market maker could, at this point, turn around and sell that interest to the market, which is what a broker would do. The difficulty is that buying from his client, the market maker's client, and then selling to the market at the same rate doesn't create a sustainable business. It's not one that, in the limit, can add value to the client's experience. But if the market maker is prepared to take the risk on, there is a possibility that another client will come the other way and take the market maker out of this risk. So that's why market makers take risk into the book, to open a window in which buyers and sellers can match off over time. Now, the market maker captures the spread as compensation for providing their service. But it's while being able to show a true market rate, i.e. a tight market rate, unlike a broker who has to actually add commission to those spreads in order to be able to generate their profits. So that brings us to the fallacy, I suppose, of the idea that market makers trade against clients. In fact, market makers are facilitating client access to market, and if you consider time, actually matching, as you see on the slide, client A against client B. And yet, one of those guys is going to win and one of them is going to lose over a given horizon. But this is the key point. Differing horizons or holding periods actually means that both sides of a trade can win, and that's particularly important in considering client interaction with market makers. So consider the period, for example, where the market maker is long and the client is short. There's no question that during that period, if the market goes up, the market maker wins and the client loses. And that, I think, is what gives this sort of superficial appeal to the idea that market makers trade against clients. But in fact, it's just that the market maker temporarily has an opposing position from facilitating client A's ability to trade on the best rate at the time that client's choosing. He is not married to that particular position. He would, in fact, like to see another client or a passive hedging order filled to neutralize the risk immediately. So, we'll consider this idea of horizon just a little bit more closely and see how different parties can win on a trade so long as they have different holding periods. So let's say that the market maker is publishing a rate 2021 and the first client A in the slide, sells. So quite short, the market maker is long at 20. And it's 3 minutes later when the market maker is paid at 21 on a passive order or by client B's interest. Another 3 minutes passes and the market falls to 17.18. Client 1 can buy back his short, earning 2 pips. The market maker's earned his spread, and the client was right about the market's direction and locked in his profit. So the market maker and client can in fact have a symbiotic relationship and the market maker can facilitate client's ability to express his trading ideas without, without the layers of costs that are necessary in any of the alternatives. So, the question is, what is the difference between market makers and brokers? And I think one of the ways in which to consider this is, let's say that you've just set up a broker or an ECN. What is the first thing that you need to do in order to facilitate your business? And you actually need prices. So you need somebody to make you a continuous stream of rates. And the question would be, well, who do you turn to provide you that service? Who is in the business of continuously forming and publishing rates that clients can trade on? And the answer to that is market makers. So the broker, the new broker or ECN will set up a relationship with one or many market makers who will stream prices into that new environment. The broker or ECN will then stream out to their clients. When the clients of that new environment, that broker or ECN trade, they immediately pass the risk through to the market maker, since by definition, as a broker or as an ECN, they're not in the business of actually taking any market risk. And it's at that point that you suddenly notice the flaw in your business model. So your clients have sold to you at the market maker's rate, and then you've sold to the market maker at that same rate, and you don't make any money. So you realize that you need to either charge commission, brokerage, or you need to provide a markup to the market maker's rate. So any way you cut it, you actually end up, as that broker or ECN, having to add a layer of cost to the market maker's rate. And in summary, that's why we think that dealing with the market maker is the most efficient way for clients to access the market. It gives traders the most effective, cheapest market access, ensuring that more of their profits stay with them. And that's the end of the presentation, so I would be happy to take any questions. How do you gain access to the market maker? Historically, actually, in the retail space, that's been hard. At Barclays, we were just simply not equipped to deal directly with retail traders. So historically, you've had this layer of brokers or ECNs mediating between the retail trader and the market makers themselves. And I think that's really what we wanted to build with Marky, is to provide clients with direct access to the guys who make the rates. So I think it's an evolution of the business model that you now have people in our position who are setting up as market makers and engaging directly with clients. Anyway, I think there's been a question just asked that I think has come through as a private one, and if you're okay with this, Jack, I'll read it out. Is that okay? Edward, let me just come back to you in a second, if that's okay. Jack's just asked a question, whether it's a job for market makers to jitter the market if their order skew is in one direction. Yeah, I guess I'd break that down into two bits. One is that the market maker does have a preference on one side of the rate or the other. It actually was one of the things that we did at Barclays was implement what's now become ubiquitous, but at the time it was an innovation, the fifth decimal place in the prices. The reason we did it was not actually to be able to, as we subsequently have done or did, show things like 0.8 and get inside of the integer boundary. It was to be able to express that preference in the rate. So if a client had sold to us, we would be skewed down, but we wanted to be skewed down by the smallest amount that would express that preference. For two reasons. One, we know that we have the objective of maintaining the greatest neutrality we can. But two, if somebody did want to buy something that would neutralise our risk, we wanted to provide them with an improvement to the rate. In other words, we wanted to be at the front of the stack, but by the minimum amount necessary. And, Eurodollar at the time, it sort of evolved to the point where it was one tick wide. Didn't work very well, really, where it was like 2021. Somebody sells to you as the market maker at 20, and you really don't have any degrees of freedom. You can either sell at 20, in which case you don't have a business, or you can simply stay at 21, but you're then at exactly the same price point as everybody else, despite the fact you are ever so slightly a more motivated seller. So that was when we came up with the 50 decimal place. So in that spot, we showed 19.9 at 20.9. And if somebody did want to buy, we had that time break and we could provide them with that concession, because we didn't want to be taking the other side of the first client's position. We wanted to just basically be matching the buyer and the seller, across time, and we were only taking the risk into our book in order to facilitate that. So, yeah, skew is actually an intrinsic part of what a market maker does. It's balanced by the understanding that you want to show the most neutral rate you can. So to the extent that you are skewing, you're doing it by the smallest amount that you can to distinguish your rate. The other part of your question is, is it part of the market maker's job or process to jitter the rate? Jitter is actually a really, very annoying thing. It's one of the things you actually get with ECNs. One of the descriptions is ECN flicker, where rates are flashing around all over the place. The reality is that rates are being formed electronically at speeds that humans simply can't engage with. So one of the things that market makers actually do is absorb a lot of that frenetic activity. And so long as the change in rate, the best estimate of rate, is small, don't publish a change to the rate. Keep it the same so that humans can trade at speeds that humans are capable of. So no, I don't think it's sensible business for a market maker to jitter their rates all around the place. So the next question is, Edwards, whether it's better to trade with an ECN than other means. And the limit, it really depends upon the cost of access. There's no question but that with market makers, there's an explicit spread being priced. That's how the market makers compensated for providing the service that they do. I guess what I'm saying here is that you need the market makers in order to facilitate the ability to be able to trade whenever you want, and that we have a model of accessing the market maker through the broker. You've actually got that additional layer of cost, which is a drag or a friction upon your trading. ECNs are distinguished from brokers by bringing together, in a sort of, if you like, unadulterated way, market makers' rates. So where brokers will blend rates and put a markup around them, ECNs, as electronic communications networks, simply going to expose the rate that comes into them out to the world as an exchange would. And they make no guarantees or assurance that you're going to get that rate when you click on it. Now, that's one of the problems with dealing with ECNs, is because the rules of engagement are basically machine against machine, they can actually be very, very hostile environments. And what tends to happen is that market makers will not show their best rate into an ECN. They would tend to show only a single side, and even then, their order times to live will tend to be very, very short. It's sort of a little bit equivalent to that thing with somebody shooting at your feet. You dance really, really fast to stay out of the way. It tends to be in machine time frames rather than human time frames, making it very, very difficult for you to actually hit either the price or the spread that you're aiming at. Just clicking on the button will just fall a little bit too slow. And then, the difficulty with the ECN is, in order for them to make a profit, they have to charge a brokerage on top of what the market maker's rate is. So all other things being equal, they will actually be more expensive to trade with than dealing with the market maker directly. It can seem a little bit like, they're pretty attractive environments because you can get some very, very ephemerally tight spreads. What tends to be happening when you see those like fleeting, very tight spreads, is you've got a latency phenomenon. So somebody has published a rate of 21.2 at whatever. Let's say they were just a bid 21.2, and somebody else has placed a 21.5 offer out there. That's because they know that the consensus is that value has moved down. The only reason that the 2.5 market, the 3/10 wide market, exists for a fleeting moment is because the guy on the 21.2 bid hasn't had an opportunity to pull it. They will almost certainly be in the process of doing so. The information market's lower is ubiquitous. Everybody's got it. It's just that the instruction hasn't reached the ECN from the market maker yet. So you'll go to hit that 21.2 rate, and you generally won't get it because it's in the process of being cancelled. It sort of strikes me that it's challenging enough to identify trading opportunities without piling on top of that the uncertainty about whether you're actually going to get the rate that you're targeting. And because of the flicker phenomenon, the fact that everything's happening at machine speeds and ECN, you're pretty unlikely to get those rates. So net, I sort of think that dealing, and I'm going to be biased, I'm going to say this, but I think it's better to be dealing direct with the market maker. A lot of slippage using a market maker. I mean, compared to using an ECN, not if you're using a good market maker. One of the things that characterizes the quality of the market maker service is fill quality and fill percentage. You're actually likely to experience far greater slippage using an ECN than you are a competent market maker. And the reason is that most ECNs are actually anonymous environments. And so there actually isn't a relationship between the market maker and the client. And so everything's extremely transactional. And the market makers on the ECNs are just like, look, if the trade suits me, I'll do it. If it doesn't, I won't. And there's absolutely no impact upon my brand if I reject that trade. The other problem with ECNs is, oh man, that's a layup. I'm going to have to say Margie FX to that one. Going back to your one, Bazza, though, is you actually get the slippage in the ECN because there isn't this relationship between the client and the market maker. The other thing is in the ECN that market makers are subject to latency. And so what's happened over time to address this issue of latency, by which I mean, it's that situation where we had 21.2 at 21.5 because the guy on the bid is trying to pull it. It's just that he hasn't successfully done so when somebody tries to aggress the rate. ECNs have been obliged, in order to maintain the support market makers to implement this phenomenon of last look. And what that means is that you go to hit that 29.2 bid, and the market maker will have 300 milliseconds or 500 milliseconds, whatever it is, to survey the world and make a decision about whether they want to accommodate your trade or not. And they can reject your interest. Now, the contrast is with a market maker where you have a bilateral relationship. You're a known client, the market maker has a relationship with you. He has every interest in providing you with the best quality of service, which means honouring your trade. And you know what? Some of the time, it's going to be offside. It's just part of maintaining a relationship with a client. So I think if you're dealing with a good market maker, actually you'll experience substantially less slippage than you would with an ECN. Your question, recommend a good market maker. It's interesting. I mean, there are some really good market makers around, but historically, they tend only to be accessible through the institutional market. Barclays are pretty damn good at it. UBS, for a bunch of the guys that I used to work with, are now working, are really, really good. State Street, fantastic. Again, another girl that we used to work with is over there now. These guys are excellent. But they don't really accommodate retail clients because they're just not set up to deal with the volume of clients that retail deals with. I think one of the reasons that we've built Marty is that historically it's been difficult for retail guys to get direct access to the market maker. Now that we're out of the institutional environment, it's our opportunity to apply the same skills as we used in the institutional space and accommodate retail clients, directly, which is pretty neat. So, were you saying that banks use dealing desks? Well, yeah, some do, which seems pretty anachronistic to us. I think when we started in 2004, we were the same. When the risk got too big, it overflowed to humans and so on. But that was only because we were figuring out how to automate the process. And I think by certainly early 2005, all of the rate formation and all of the risk management was actually totally automated. And that will achieve those two things that I was talking about previously of neutrality, because the computer is, he's got no opinion. He's just aggregating all the information that it has available and maximising the certainty of the rate so that we can increase the spread because we can process so much information so fast. So there was actually, certainly in the Barclays model, absolutely no discretion applied to either the rate formation, the question whether the rate, the trade was honoured, or the risk management process. So it depends. Some market makers have dealing desks, others have completely automated the process. It's interesting, but the guys who have got the greatest market share, the guys who have sort of consolidated market share over the last 10 years, have been the people who have got the greatest degree of automation and don't exercise discretion. Bazzy, you're saying that most don't like clients to scalp. And why do we embrace the activity? Well, scalping, just in terms of clearing a couple of definitions, I suppose, in my mind, is trading over short horizons. The reasons that market makers, some of the guys who style themselves as market makers, don't like it, can be because, first, they're actually not committed market makers taking every trade into their own book. And so what they need to do when you place an order with them is they need to place an order with one of their guys, one of their market makers, and they can miss the trade where you're looking to trade for short holding periods. The other problem is that question of complementary horizons. If, let's say, you made your money inside of a second, there's going to be only the tiniest of windows for somebody to have come another client to have come the other direction and neutralize the market maker. So if you're continually successful over very, very short horizons, that money has to come from the market maker. And that's why they kind of get sad. But the reality is that so long as you're not engaged in latency arbitrage and so long as your holding periods are sensible, there is still an acceptable window in order for, particularly in a mature portfolio, for another client to come the other way. That other client is obviously disagreeing with you, but that's fine. That's part of what it is. Ultimately, you're trading against someone. And I think if you remain true to the market making ethos, then you accommodate all of these trades. And we don't have manual execution. We don't believe in it. We don't think that clients should have to wait, a human reaction period to be told whether they've been filled on a trade or not. Just give it another minute or so in case somebody's forming a question. But if you think of something after we get done, feel free to drop me an email at david.cooney@mahifx.com, and I'll come back here, do my best to answer it. So if no one has anything else, I hope that was helpful. Any questions, anything you want to comment on, please just feel free to drop me a line. Yeah, you're right, Peter. It's not advertised that much. I think the guys who probably are closest to us, I don't like to say we're better or whatever, but the guys who are closest to us would be Olander, I think. And I think that's why, when you compare our spreads with peers and so on, that's the reason they're probably not as competitive, but the most competitive compared with us. They're the only ones I know of who are reasonably pure about the whole thing. Oh, so sorry, I was responding to a question from Bazza. Just asking what other market makers are out there other than MarketFX. He was making the point that it's not something that was advertised, which is why I was saying Orlando are pretty good. It's interesting that they don't talk about it so much. If you like this kind of thing, it's somewhat interesting. I think that the really, really key thing for the retail trader, though, is just to understand what service it is that your broker, that your counterparty is providing. And that's the reason that we're very explicit about the fact that we do market make. And to try and explain not only, would expose not only the spreads tighter, but explain why they're tighter and why we believe we can sustain that. Sorry, Vicky. Jax just asked a question. Which I'll just answer real quick if that's okay. And the question is a big gap, meaning that no market makers were there to bid, like on the Euro Open today? Well, yeah, I mean, I guess a big gap does mean that no one was there posting the bid. But if we step out to what the market makers are trying to do, they're actually trying to achieve a balanced expectation on both the bid and the offer. So they don't know ahead of time whether a client is going to sell or buy. So they're looking to place a rate which is such that the expected profit from both sides of the rate is exactly the same. If a market is falling very, very rapidly, there is a failure, if you like, of price discovery. No one really knows where the balanced expectation rate is going to be. So market makers will tend to move with the market in an attempt to place that balanced expectation rate once things stabilise. You see it a lot in the aftermath of news releases, like when you get non-farm payrolls. You'll get a large jump, and a lot of liquidity, the market making liquidity is explicitly taken from the market during that period. So the moves tend to be accentuated because there isn't no liquidity available to absorb them. A typical protocol, one that we followed at Barclays, one that we follow at Mahi, is that when we put non-farm payrolls, the spreads will go out to 10 times their conventional width, 5 seconds preceding the release and for 10 seconds afterwards. And it's during that 10 seconds where the new information is being incorporated into the market rate, and then you'll tend to find the market make stepping back in and laying two ways around that established price point, and then working at the process of skewing rates in order to encourage risk to clear. So yeah, it tends to be that the market makers have gone away because they, like everybody else, like we've just got a unidirectional piece of information being priced in the rate. It tends then, of course, to accentuate the move because some people are being stopped at the same time as liquidity is taken out of the market, causing the impact of those sells to be even more dramatic than normal. Like I was saying, so we'll just wrap it up there. Thanks a lot for listening to me. If you have any questions, just drop me an email. It's david.cooney@marketfx.com. And we'll talk to you again soon. Thank you very much.